Ron,
Hi, Kelly.
oh my gosh, where do we begin this week? Where do we begin?
Well, it's this whole thing's been a Rorschach test for everyone, right? I mean, you kind of see in the ink blot everything that you want to see in the Fed statement and Chair Powell's commentary thereafter. I think it was fairly straightforward. They acknowledge a slowdown in spending and production. They recognize that rates still have to go higher. They admitted they're closer to the end than the beginning of the cycle. And so I don't know, what confusion there really is around this, other than to say that the financial markets have responded appropriately. There's a little more room to take risk. Bond yields have fallen. Stocks have rallied. Commodities have moved up a bit. And so I think to a certain extent, it's not as nearly as unclear, even with respect to forward guidance, which they're still going to give, as many people suggested Wednesday and Thursday.
So if I had to boil this down in a nutshell, I'd say the Ron Insana camp is the camp that thinks inflation is going to normalize very quickly on its own or as a result of what we've just seen. Is that right? Because I would say that differs with what Diane Swonk was warning about last hour. I don't know if you caught it, but basically saying she thinks that the Fed's not going to be able to cut rates next year. Inflation is going to be persistently high, and a report like we got this morning demonstrates that.
Well, persistently high. I mean, again, I'm still sticking with the analog of a post-war environment, that it may take 1, 2, 2.5 years for inflation to normalize when you've had supply disruptions and demand exceed that constrained supply over time. I do think the Fed's getting closer to stopping sometime next year. I don't think that a pivot is in the cards just yet. I mean, and I think that was another misinterpretation. All of a sudden, everyone jumped to the notion that next year the Fed's going to start cutting rates. It's absent a large recession or some real event that causes systemic financial risk. There'd be no reason for them to lower rates, just as within a matter of months, there's probably no further reason for them to raise. We do need supply chains to normalize, though, for inflation to come down. And look, Kelly, we know inflation is not going from 9% to 2% by this year. If we can get it down to 4 this year, 3 and change next year, we'll be on a path that looks very similar to post-World War I or post-World War II, which, again, I think there are the more appropriate analogs for this period than, let's say, the 70s and the 80s.
Ron, I wonder, I mean, you mentioned this idea that there's a misinterpretation of this idea that there could be this, so to speak, Fed put, right? We've spoken about it numerous times in the past over the years, this idea that the markets are kind of dictating whether or not the Fed is going to step in with more accommodation or keep it and whatnot. I wonder if it's now this notion that there's a GDP put or a GD put, if you will. Does the economy now, the data, the backward-looking data now suggest that would be the catalyst for a potential easing of financial conditions?
So, Dom, it's funny you bring that up, because one of the things I also point out with respect to the Fed being data dependent, the Fed has always been data dependent. You and I have always been data dependent. Anybody who has access to data is data dependent. And so whether or not it's GDP, whether or not it's systemic financial risk, when we talked about a financial put over the last 20, 30, 40 years, it really had to do less with a technical recession or something that would be akin to a growth recession or a slowdown than it had to do with systemic financial risk that could cause a very, very big shock in the economy. It looks like the Fed's willing to tolerate slower growth. It looks like the Fed's willing to tolerate a mild recession. What they might not be willing to tolerate is something very deep and prolonged, which they've never tolerated in the past. So the put's always there, but it's as much as it hasn't been used sparingly in recent decades, we've had a lot of financial crises that threaten the system, which is why they've been in and out of the markets this way. But a GDP put, I don't think so, unless you saw a -8, -10 print like we did during the pandemic.
Shepard Smith here. Thanks for watching CNBC on YouTube.